Today I want to look at the side-by-side package again, and in specific the simplified ETR safe harbor. And as I said last week already when we looked at the side-by-side system, I am not a big fan. To start with, if we look on the right hand side, you can see from the table of contents that the simplified ETR safe harbor starts on page 10 and it runs all the way to page 68. Now let me be very clear. Anything that takes 58 pages to explain is not simplified. That is not how simplified works. If we look at a high level what the simplified ETR safe harbor consists of, you can see there's an introduction, and to be fair to them about all these pages that they use, they do summarize everything twice before writing the explanatory text. And that is what part of the introduction is about. And then you have the simplified jurisdictional effective tax rate that they explain. You come to simplified income or loss, and my issue, and you will see it in a moment, is it is not that you only take one or two posts. You more or less have to go through everything that you normally would go through in your Globe information return in any case. The same applies for the simplified taxes. Then they come up with a simplified treatment of cross-border income, and a large part of that is a simplified treatment of permanent establishments, and we'll get to that in a later video. But again, my issue with these kind of gifts is how many PEs do you have in your multinational? And if the answer is none or only one, then you're probably like 95% of all other multinationals. PEs is things that people are trying to avoid. It's not things that they go and set up all over the place. The same argument applies for tax neutral entities. Wonderful that they added a lot of pages about that. Very few people have them. And then at the end you give and then you take, and there are a list of eligibility constrictions as for when you are and when you are not in the safe harbor. I'm not saying that you don't need them, I'm just saying it adds to the complexity one more time. If we dive one level deeper into the table of contents on the far right, you can see there are quite a number of bullets that are covered, and not all of them are even filled out yet. As I said, there's an introduction and in 1.2 an overview of the simplified ETR. So there are a lot of summaries of summaries. Then if you look at 2, you get to the tested jurisdiction and source of information. And source of information is a bit of an irritating one already, because there is language in there that says if your QD-MTT must be done according to your local accounts, then so must your simplified safe harbor return. So now you're going to have to deviate in that way in any case from your Globe information return. You come to the simplified income or loss, and the big issue here is PBT, jurisdictional profit before tax. A whole new bunch of acronyms appearing on the scene. You can see that they talk about industry adjustments. When I saw that I thought, oh dear. But it turns out fortunately that those are the insurance companies and the shipping companies. So nothing new, but everything is still in the permanent safe harbor. And then you come to these things called conditional adjustments and optional adjustments. And so what they've done is some things you must do, some things you must do if certain circumstances appear, and then everything that is a goodie that you would have done in any case because it is a goodie and it helps you, those are now optional. So I guess the idea is if you're above 15% already, why bother with the extra data? You do the same with the simplified taxes. You see again another ugly acronym, the JITES, or the jurisdictional income tax exclusions. One more time, you have simplified adjustments, you have optional adjustments, you have rules for transitional years and tax adjustments after year end. So you import all of 446 and all that trouble. And then the simplified treatment of cross-border taxes, as I just said. Great that we can have a simplified treatment for PEs. Fortunately, we do not have a lot of them, so we won't use that. So to summarize what the simplified ETR safe harbor package does, or what the OECD has done with this, and this is the OECD together with especially all the governments around the table that really sometimes go way over the top. So here you see they took out the stuff you most likely were never going to be doing in any case. Most of us do not have PEs, most of us are not in shipping, we do not have the hybrids, those kind of things. Then from the rest of what's left, they kept all the top-up tax raising stuff, obviously. They made the remaining top-up tax lowering stuff voluntary, so that's why you have these different categories of conditional and optional and mandatory. And then they added a PE simplification, which many of us won't use, and they fixed some broken rules, such as the PPA accounting, which they simplified down for us. That in the first place should never have been that complex. Maybe they should have fixed the basic rules, then they didn't have to present the fix as a safe harbor. And then finally they said that this is better than the transitional CbCR. What they forget to say is that if they made a few tiny tweaks to the transitional CbCR and the CbCR rules, such as fixing the issues with gains on shares, then you never would have needed the permanent ETR. You could have simply used transitional CbCR and make that permanent. I do not understand this insistence on not applying the transitional CbCR. Where does this leave us visually in terms of what we now need to do, what we used to have to do under the transitional CbCR safe harbor, and what we are going to need to do under the permanent ETR safe harbor? If you look at the page in front of you, all the pages together, that is what you need to fill in when you are doing a globe information return. If you do not have to pay a top-up tax, then, and for whatever reason you're not on a safe harbor, you can maybe skip the last 4 pages. There's 1 page on shipping, but those are the 30 pages that you need to do, and then 27 if there's no top-up tax. If you have the transitional CbCR safe harbor, you do the left-hand 2 columns. That's it. 8 pages. You do need to add 1 page maybe for your substance-based income exclusion calculations, but then you're done. Instead of this, we are now going to get the permanent ETR safe harbor, and like I said, it keeps most of what is in the QDMTT already, with a few tweaks and some places even a few fixes here and there. So you will add in total another 12 pages that you will need to fill in. You do still need to fill in the second column on this page too, because you need to give them information on the safe harbors. You're just not going to put in there the transitional CbCR safe harbors, which is, I think, 1 or maybe 1.5 page by itself. So you can see doing the permanent ETR safe harbor compared to doing the transitional CbCR adds a good 12 pages of tax returns to your work. It is a huge increase of the compliance workload for what I believe ultimately is very little gain, or for gain that could have been achieved much easier otherwise by fixing the issues with the CbCR safe harbor. To show what was said before in terms of calculation, so if you were to do a calculation on a country-by-country basis, which you need to do in any case for QDMTTs, but also just as a reality check for whatever software you are using, you will, under the transitional CbCR safe harbor, you will have something like this. You will fix your currency, you will take the applicable percentages for the substance-based income exclusion wages and for the tangible assets. You will see if you qualify for any of the safe harbors, and if you do, you're done. You have very few lines to fill in for that jurisdiction, and this simplicity duplicates into your QDMTT return. Do not forget, all the complexity which is brought in by the simplified ETR safe harbor is going to spill over in your QDMTTs as well, because they will not be simple transitional CbCR safe harbors anymore either. No, you would need to do all the extra work that I just showed you for your QDMTTs as well, if you want to rely on a local QDMTT ETR safe harbor. Now compare the previous slide that shows you the calculations for the transitional CbCR safe harbor with what you need to do for your permanent ETR. What you see on the left hand side is all the adjustments that you need to make to get from your final to your globe income in your normal globe information return if there are no safe harbors applicable. The second column shows you where the different globe rules can be found. And the third column shows you for the simplified ETR which of all those rules you are going to have to check in order to apply for the simplified ETR. And then the last column has some comments whether these are optional adjustments, conditional adjustments. There are some extra relief. For instance, under the globe information return you can only ignore fines up to 50,000 euros. Under the simplified ETR that goes up to 250,000 euros. What the value of that would be in real life, I think is going to be minimal. And when you're done with all this, you just have calculated your globe income. You haven't started on your taxes yet. And then finally, you see here the same calculations for your current taxes and your deferred taxes, so you can get to your adjusted covered taxes. Same layout. The different rules have names in the left-hand column. The globe rules are in the second column. The simplified ETR references to the globe rules are in the third column, and I miss a number because I was running out of time. And the same on the right-hand block for the deferred tax calculations. So all in all, you can see that the simplified ETR safe harbor is not simplified at all. It is causing a huge amount of extra work. What it does, it basically takes everything that you were going to do in most instances, in any case, in countries where you are not in a transitional safe harbor, and it's making you do that, and now says, look, we've made things simpler for you. I am a big fan of the OECD. I'm a big fan of a global minimum tax, but I do not like this persistent insistence of creating unnecessary complexity. Next time we will look at the technical details of all these adjustments so that we can learn how to do these things. And my guess is that as terrified as the OECD has been of opening loopholes, this system, which is basically a side-by-side system to the Globe Information Rules, is gonna very much open the door for tax planning. See you next time.